So we are going to start a little two-part series on the two sides to theta. And today we are going to address the positive side. Now, before we get to the information, let's think about what theta is. Let's think about what we are trying to accomplish as traders, as option buyers, option sellers, whichever side of the fence you might be on. We're trying to make money, right? We're trying to generate returns. Well, how do you do that in the derivative space, specifically the options space? You basically do it one of three ways. You do it through direction, you do it through time, or you do it through volatility. Well, theta is really going to highlight the time aspect of generating returns or potentially earning losses, whatever it might be. It's going to really kind of, drill down on the time element of the returns because theta is the first derivative of the Black-Scholes model with respect to time. So it is going to literally show us how an option price is going to respond when time itself changes. So John, go ahead and bring us into the information today. So the positive side. So there's essentially two sides to the theta discussion. There's the positive side and there's the negative side. You're positive theta or you are negative theta. There are times when you could have essentially zero theta, but those are going to essentially be very few and far between, a lot less common than either being positive theta or negative theta. So today we're going to talk about positive theta. When you sell an option, you are always able to generate positive theta. Always. Like always, always, always. Now, if you sell a spread or if you have like a complicated strategy, then that may not necessarily be the case. But if I'm just talking about a very single, basic, plain vanilla Betty Crocker option, I'm selling a call, I'm selling a put, whatever, you are going to be able to generate positive theta. It doesn't matter if the option is out of the money or in the money or at the money, you will have positive theta. But I'll have a bit more to say about moneyness here in just a couple of seconds. The natural decrease in extrinsic value as you approach expiration is helping you. This is what positive theta essentially means. So if you remember, just recently we did that deep dive into extrinsic value, and we'll even link down to that show on YouTube for you guys so that you can easily find it. But we did the deep dive into extrinsic value. We talked about time, we talked about volatility, we talked about the proximity effect. And one of the things that we mentioned in that series, I don't think I spent a lot of time on this, but it was definitely something that came out of the woodwork at one point or another. Whenever you have an option, it's going to have some amount of extrinsic value, right? And obviously we talked about how those three different factors impact and influence extrinsic value. But one of the most important things to understand right here and right now is the following. Whether you're 7 days away, 21 days away, 35 days away, 65 days away, it doesn't matter. You have some amount of extrinsic value in that option. When that option finally reaches expiration, it will have zero extrinsic value. There will be no extrinsic value left. The option price will collapse down to its intrinsic value only. And if the intrinsic value is 0, then the option price will be 0. If the intrinsic value is 5, then the option price will be 5, and so on and so forth. But understand that option prices are going to slowly decrease as they approach expiration, ceteris paribus, all things being equal. That is because as time withers away, as time decreases or moves closer to expiration, the theta of the option is putting downward pressure on the option price. Specifically, it's putting downward pressure on that extrinsic value. Because remember, intrinsic value is just determined by the moneyness of the option. It's only determined by whether or not the option is in the money or not in the money. And so time and volatility, that doesn't impact intrinsic value at all. It's all extrinsic value, which we talked about again in that deep dive inside of extrinsic value that will be linked down in the show notes to this show. But that slow decrease in an option price as you get closer to expiration, right? That downward pressure, that is going to help you when you sell an option. Because remember, if I sell an option, I'm selling it at some price up here, whatever it is, $2, $4, 85 cents, it doesn't make a difference. I want to ultimately buy the option back for some lower price. So I want to sell it for $2 and buy it back for $1. I want to sell it for, $1.85 and buy it back for $1.15 or whatever. I want the option price to move lower. Okay, put these pieces together. I've got positive theta because I've got this downward pressure on the extrinsic value over time. That's what I want. I want the option price to move lower. So having positive theta by selling options is going to help me reach my objective just by time moving forward, because it's eliciting this downward pressure on the option price in the form of a slightly lower extrinsic value day in and day out. Okay, now let's put all this together. This isn't as much of a deep dive as maybe we went into for extrinsic value. This is more of kind of a basic kind of Theta 101 type of course or type of discussion. When we sell options, because there's a lot of other things we could get into, but I wanted to keep this somewhat neat and somewhat tidy. When we sell options, we prefer to sell out of the money options. Now, from time to time, we might sell an at the money option, and there are some, really, really rare instances where we might sell an in the money option, but the default setting, kind of our status quo, is going to be to sell an out of the money option. Now, why do we do that? One of the main reasons that we do that is because if you sell an out of the money option, you are going to have a probability of profit, a pop, on that position that is greater than 50%. You are going to have a greater than 50-50 proposition. And we generally feel like, man, that is a great foundation to work from. Like, what a great, kind of framework to kind of build out the rest of my portfolio from, where I have probabilities working in my favor. I have them on my side. And then there's all kinds of adjustments and managements and other little tactics that you can deploy, along the way. But this is kind of the base level foundation. Okay. The reason why that is the case is exactly what we've just talked about over the course of the last 4, 5, or 6 minutes. Probability of profits being greater than 50% for an out of the money option. The reason why that is the case, and it's the sole reason why that is the case, because those options have positive theta. In other words, I don't need to get the direction right. I don't need volatility to move in my favor, right? The other two things that are essentially driving options P&L. I just need time to move forward. I just need this option to get closer and closer to expiration, which of course we all know that is going to happen. There's nothing that I'm going to need to do. There's no additional energies I'm going to need to, exert on this position to essentially make that happen. It's going to naturally happen itself. And so because of that, when you sell an out of the money option, a call or a put, it doesn't matter. You will always see your probability of profit being greater than 50%. The reason why that's the case is because factored into those probabilities is time working on your side, right? Positive theta working in your favor, that downward pressure that is being placed on the extrinsic value that is essentially helping you as an option seller, which leads you into a situation where you just need the stock to not beat you, right? You just need the stock to essentially stay in a certain spot and you will be fine. Again, we just feel like that is such a great foundation to work from when it comes to building out all the other things that we like to do. So that is a brief introduction to understanding the first side of theta, the positive theta side. We are working through the two sides to theta. And just yesterday, we worked through the positive side of theta. And of course, today, we're going to flip over to the negative side. But before we even flip on to that negative side and kind of work through some of the the vagaries and the subtleties and the nuances of being negative theta, it's important to remember to make money in the options world, right? As a derivatives trader or a derivatives investor, if there are even those types of things out there, it's direction, it's time, and it's volatility, right? We talked about that yesterday from the positive theta side. It's going to be a very, very different type of take and angle today from the negative theta side. So Josh, go ahead and cue us up on the information today. So when you buy an option, this is when you are going to generate negative theta. So again, remember, yesterday we sold options. Yesterday we were positive theta. Today we're buying options. We're going to be negative theta. This is where it's really helpful to remember that at the end of the day, options are what are referred to as a zero-sum game. So that quite literally means whatever one side of the contract makes or wins, the other side of the contract is going to lose, and vice versa. So at the end of the day, for that contract, it's going to net out to zero. The profits on one side are going to equal the losses on the other side, and vice versa. So When you're learning about options and you're learning about derivatives and you're learning about theta and you're learning about delta and you're learning about all the vagaries and subtleties and nuances, it's really helpful to remember, all right, if I understand one side, then indirectly, I kind of already understand the other side, because you're not going to have an option situation where, the buyer is positive theta and the seller is positive theta. Like, that's not a possibility. You're not going to have a situation where, the buyer is negative delta and the seller is negative delta. That doesn't make sense at the contract level. So understanding that when you sell options, you're positive theta. When you buy options, that's when you're going to generate negative theta. Now, can there be situations when you have sold an option, or more specifically, sold an option spread and it actually turns negative theta? There can be, but that's way further down the road than I want to go here today. But just file that away in the old memory banks as a future project that you could undertake. Okay. You're negative theta, you bought the option. So what does that actually mean if we push it a little bit further, kind of maintaining the same parallel that we established yesterday with the positive theta side? That means the natural decrease in extrinsic value as you approach expiration is hurting you. Remember, it was helping the option seller. It was helping the short side of the contract. So naturally, it's going to be hurting you, the option buyer. It's going to be hurting you on the long side of the contract. Again, simply put, it's a zero-sum game. So if it's helping one side, it's hurting the other side, and vice versa. The reason why this is the case, though, if we just go one or two steps further, remember, when you buy an option, you're buying the option for some price here. What do you ultimately want to have happen to that option? What do you ultimately want to have happen to that option price specifically? You want the price to go higher. It's no different than when you buy Apple stock, or you buy McDonald's stock, or you buy Wolf stock, assuming they're still in business, which is a pretty big assumption. But if you buy any stock out there, you want the price to go higher, right? You want to buy it down here and then sell it up there. It's really that simple. It's no different with buying a call or buying a put. Okay, remember, we have this downward pressure on extrinsic value that we learned in the extrinsic value series, and we went ahead and reminded ourselves of just earlier when we went through positive theta. If I have this downward pressure that is causing the extrinsic value to slowly whittle away as you get closer and closer to expiration, that is going to be a tailwind for the option seller. That is going to be a headwind for the option buyer. Because again, remember, the option buyer wants the option price to move higher. He or she doesn't want the option price to move lower. That is going to move and work counter to the objectives that they might have for that position. So as the extrinsic value goes lower, as you approach expiration and get closer and closer to that end point for that cycle and for that specific position, the extrinsic value, the downward pressure on the extrinsic value, I should say, is working against you. That is what negative theta means. Okay. What is this actually going to do to you as an option buyer? What is this actually going to cause? Like, what are going to be the implications of this for your position? Well, that is what you see there in the two yellow boxes on the bottom of this slide. Number one, you are naturally now going to have a greater emphasis on direction to make money. It's really that simple. At the end of the day, you're only making money in one of three ways. It's time, it's direction, it's volatility. Yeah, there's like dividends in there, and there's interest rates in there, and there's smaller players that factor in from time to time. But the main movers are going to be time, direction, and volatility. Well, time, we've just established, is now working against you. Right? So remember earlier with positive theta, we had probabilities greater than 50%. We didn't have to be directionally correct. Like volatility was, really neither here nor there at times. And we would be able to generate all of the P&L that we might be going after from time alone, from positive theta alone. But here, it's a very, very different scenario, right? Because now I've got time working against me. So what do I need to do? I need to make up for that. Right? I've got to overcome that in some way, in some regard. And so now I'm just left with direction and volatility. Well, could you make up for that with volatility? You could. But by and large, on any given day, any given Sunday, for my Willie Beeman fans that might be watching the show today, you are going to make or lose more money from the directional impact on the position than you are from the volatility impact. And so essentially what you're doing is you're causing yourself to now need a greater emphasis on direction for that position to be successful, for that position to be profitable, because time is now working against you. One final point. And again, remember, this is very much kind of a Theta 101. This is very much kind of a little olive branch to the new traders out there that might be just considering options. All of this stuff is a foreign language to you, and you're trying to understand this stuff at a very basic, kind of cursory level. But one final thought to kind of, nudge you into the forest for some more self-study on your own. Theta, all things being equal, actually increases as you get closer to expiration. Now, this works, on the other side too, if you sell the option, even though I didn't address this when we talked about positive theta earlier. Theta increases as you move closer and closer to expiration. So that means if I buy an option, the negative theta, the daily cost each day in extrinsic value dissipation, is actually increasing as you get closer and closer to expiration. So today, maybe it's negative $5 in theta. Tomorrow, maybe it's $5.30. The next day, it's $5.60, and so on and so forth. So what does that actually mean in practical terms? Well, that means that the hurdle that you have to jump over, the obstacle that's in your way that you have to navigate around in the form of time working against you, it's actually costing you more and more every day you're in the position. Or put another way, if you buy a call or you buy a put, it works on both sides. If you buy an option, call or put, you are going to find yourself kind of needing to be directionally correct more quickly than maybe you realized, because once that theta begins to grow a little bit of teeth, and all of a sudden, each passing day is costing you more and more, it is quite literally increasing the hurdle that you have to jump over to be successful on that trade. Now, are there ways around that? Are there ways to mitigate that? Of course. I mean, you get into moneyness, you get into strike selection. Again, you get a bit further down the road. There are ways to mitigate this, but it doesn't change the core fact and the basic foundation of time working against you and every day that passes costing you a little bit more and a little bit more. And so this is really why, at the end of the day, we much prefer to sell options rather than buy options. But there is a little discussion around the two sides to theta.
If you're not subscribed, subscribe right here. And if you want to meet me and the team in person at our next live event, hit the link at the top of the description.